let's dive right into it. Welcome to today's Explainer. We've got a lot of ground to cover. We're translating all that extreme global macro tension we saw overnight, and frankly, over the past few days, directly into actionable trading levels for your terminal. So let's jump straight into the technicals and the catalysts driving them right now. Now, to really understand our current technical posture, we have to talk about this massive geopolitical overhang. The quote of the day: diplomacy is alive, but barely breathing. President Trump actually paused that planned military strike on Iran after getting requests from Gulf nations like Saudi Arabia, Qatar, and the UAE. But look, with the U.S. redirecting at least 85 ships and Iran issuing some pretty stark warnings about the Strait of Hormuz, the threat of a full-scale assault is literally keeping markets right on the edge. And you can see exactly how that stress is manifesting in the bond market. We're talking 4.66%. That geopolitical uncertainty briefly sent the U.S. 10-year Treasury yield soaring to its highest level since February 2025. When you combine a spike in global yields like that with climbing crude oil, well, it's the macroeconomic equivalent of getting a massive headache and the bill at the exact same time. Markets are practically being forced to price in these higher-for-longer inflation risks overnight. So looking at the broader overnight macro wrap, we're witnessing an absolute tug-of-war. On one side, we have severe geopolitical inflation fears. Brent crude is hovering near $109 a barrel. On the other side, you've got this AI-driven tech optimism trying to keep equities afloat. It left us with a totally mixed U.S. session. The Dow closed up about 0.32%, while the Nasdaq fell 0.5% under the weight of those rising bond yields. Meanwhile, gold is quietly climbing towards $1,600 as safe haven demand stays super elevated. And get this, G7 officials are literally meeting in Paris as we speak to hash out financial stability risks. All right, let's move into section 1, the currency board. We're breaking down global technicals and the upcoming catalysts. Starting off with the US dollar index, or the DXY. It retreated slightly as US 10-year yields eased back down toward 4.59% once that initial Iran panic sort of subsided. But the structural tactical view here? It remains a really solid buy-on-dip setup. Immediate support is sitting right at 99.00, followed by the 98.70 to 50-day weighted moving average. On the upside, look for resistance at 99.64. And definitely keep an eye on the calendar today. The ADP weekly employment numbers are dropping, and we've got Fed Governor Waller speaking. Those are your key soft points driving this index today. Jumping across the pond to Europe. Right now, intense energy sensitivity is absolutely the euro's biggest macro vulnerability. Given their heavy external dependence and oil trading up near $110, it's a rough spot to be in. Because of this, the euro to dollar pair is a strict sell-on rise. Now, the pair did bounce pretty sharply yesterday off that key support level at 1.1612, but structurally, the headwinds are just way too strong. So watch for resistance at 1.1656 and then 1.1688. Today, keep an eye on Eurozone trade data and remarks from the ECB's Philip Lane. Those are the critical soft points to monitor here. Over in the UK, the British pound actually bounced back surprisingly hard as UK 10-year yields dropped almost 14 basis points, which offered a little temporary breathing room. But much like the euro, the tactical view here is a firm sell-on rise. Why? Well, higher debt servicing costs are severely constraining the UK government's fiscal flexibility right now. If you're trading cable, resistance is parked firmly at 1.3450, with supports at 1.3393 and that crucial 1.3326 level. The major catalyst to watch today is the UK labor market data. We're expecting unemployment to hold steady at 4.9%, with wage growth still pretty elevated near 3.8%. Now, this brilliantly illustrates the sheer tension that's just ripping through Japanese markets right now. On one hand, you have the fundamentals. Japan printed stronger than expected Q1 GDP, up 0.5% quarter on quarter. That is aggressively fueling bets that the Bank of Japan might actually hike rates again in June. But then you look at the technical reality. Despite those solid fundamentals, the yen just broke above a massive pivot point at 158.78. Literally, nothing seems to be helping the currency right now. So, what are the actionable levels for the dollar-yen? Well, Japanese yields have completely surged to become a primary focal point for global bond markets, with the 10-year trading uncomfortably above 2.70%. The tactical play here is pure caution. You have got to watch out for BOJ intervention. Key resistance levels are parked at 158.91 and then way up at 159.77, while support is sitting at 158.46. Honestly, it feels like the market is effectively daring the Bank of Japan to step in at this point. Okay, moving on to section 2, the domestic front. Let's zero in on India, specifically the Nifty and the Rupee. The absolutely crucial number today is 96.3450. The Indian rupee weakened to this devastating record low, making it one of Asia's absolute worst performing currencies right now. To put that into perspective, it's fallen nearly 2% in just the last 7 trading sessions alone.
The domestic pressures crushing the currency are just immense. Even though the RBI has been intervening to try and cushion the blow, they are fighting a massive tide. We're talking persistent foreign outflows exceeding $23 billion since March. You combine that kind of capital flight with the sheer weight of $110 oil inflating import costs and widening the balance of payments deficit, it is a perfect storm. As a result, the India 10-year bond yield has spiked all the way up to 7.13%.
So, translating all that macro chaos to the USDINR chart, the buy-on-dip strategy has worked absolutely perfectly for market participants so far. Our initial target of 96.18 already done and dusted. Based on the current momentum and all these external pressures, the technicals are pointing to 96.90 as the next logical target. If we do see a pullback, expect immediate support around that old 96.18 level with deeper support down at 95.82. Now let's wrap up with Indian equities. Yesterday, the headline indices really masked a ton of underlying pain. The Nifty 50 basically flatlined, ending up just 0.03% to close at 23,649. And the Sensex barely eked out a 0.10% gain in what was a highly volatile session. Honestly, they only survived because IT stocks surged 2.4%, riding the wave of a stronger dollar, which boosts their earnings outlook. But right beneath the surface, investors were aggressively dumping risk. The broader small-cap index fell 1.3%, and mid-caps slipped 0.2%. The broader market is quietly bleeding out. Structurally, because of these massive geopolitical headwinds, the tactical view for the Nifty remains a very strict sell-on rise. Investors are trapped in this really tight band right now. Looking at the technicals, strong resistance is sitting up at the 24,806 to 50-day weighted moving average zone, with immediate resistance a bit closer at 23,950. On the downside, the supports you need to watch are 23,578 and 23,439. As long as these persistent fears around the Iran conflict and elevated oil prices hang around, they're going to dictate the mood and cap any sort of meaningful upside rally. All of this leaves us with the ultimate question for today's trading session. Will central bank interventions, whether we're talking about the BOJ in Japan or the RBI in India, actually be enough to deter these aggressive market trends? Or has the global economy simply decided to price in global chaos, triple-digit oil, and higher for longer interest rates as the permanent new normal? It's a lot to think about. Definitely keep a close eye on those key support and resistance levels we walked through today. Stay disciplined out there. And thanks for joining me for this explainer. Until next time, trade safe.